Sridhar Sivaram joins us. Let's take the conversation forward. Sridhar, I guess investors have two choices. One, they can wait it out and wait for a bad patch where they will get stocks at their levels. Or second is that they'll have to throw in the towel and participate. Those who've participated and have ignored valuations are the ones who are feeling happy. And those who've been waiting for the right level, the right moment, the right period, the right stock, they are either getting frustrated or they're panicking or they're feeling left out.
Yeah, so I think somebody had once said in one of the books I was reading, it's time, not timing. So it's the time you spend in the market that gives you the return. So I guess there are uncertain times in the market like what we have right now, but still within that you find enough opportunities. And there are times when the market's just flat and goes nowhere, and you see that sort of markets also. So I think most of us who are in the markets are most invested in the market. We don't have the option of staying out. It's just a question of how you position your portfolio. So I guess that's the broad answer I can give, that it's the positioning of the portfolio which matters in the uncertain times like this.
Would you like to, throw in some more light on as to what currently, according to you, is a good positioning? Take a shelter in IT pharma or bend towards cyclicals and perhaps stories which will benefit when the economy recovers?
So I guess it's a blend of both. I mean, one of the things that we've been playing is the whole China plus one, theme, which includes many sectors actually. You can talk of, API companies, you can talk of CRAMS, you can talk of chemicals, textile exports. So many of these sectors benefit from the China plus one, opportunity. Some are able to grab a little bit, more are expected in the near future. So I think the markets today is willing to give a higher multiple to companies which are able to or in a position to grab these opportunities. So that's one. Surely on the cyclical side, especially when it comes to commodities, we think that there is enough value. We've seen commodity prices rally substantially from the March lows. And even now, many of these stocks are trading at, say, 0.5 or 0.6 book. And if one has to take a view that as countries come out of the pandemic, government spends will become more important to revive economies. Spends in infrastructure, as a result, demand for commodities will go up. So I think that's a broad play. I mean, this is not an easy trade, especially the cyclical trade. There's no instant gratification here, and it's a patience game. So one has to wait and, see how things play out. But over a period of time, at these valuations, cyclicals, some of them, like what I mentioned, do give good returns.
Sridhar, you've been an advocate of strong rural growth, largely owing to the agricultural reforms, etc. Spoken about this theme. Do you think that even the encouraging numbers that we saw within the auto space would reinforce this theory?
I think very much. I spoke about this when the agri reforms were launched sometime 3-4 months back. And as more of the details have flown in, it is very clear that even before the reform, the agri and the rural economy was doing well. As these reforms play out in the market, we'll see more benefits to the rural economy. So we remain very positive as far as stocks which have some play with the rural economy. Unfortunately, there aren't too many direct agri/rural plays. Most of them are derivatives. So either it's a tractor or it is a two-wheeler or some sort of a consumer play. So whatever is possible within that ecosystem, we remain very positive. And we also think this gives a boost to consumption. And that's how you play the second derivative of increased rural income. So we remain positive on all these plays, whatever is possible within that agri space stroke consumption plays.
And what's the view on Telecom? How have you read into the latest developments? Do you continue to bet on this space?
Yeah, we remain positive on Telecom, actually. We've seen some part of the move and then some correction as far as Telecom is concerned. But we think from here on, it is going to be the ARPU game. I mean, India has a $2 ARPU. The overall telecom revenues 3 years back were about 2 lakh crores. Today, it's about 1,50,000 crores. And in this 3 years, data usage is up 10 times, minutes of usage is up about 30%. So I think, and the dependence on mobile and data has only gone up. So we do think that over a period of time, this ARPU, this $2 ARPU cannot sustain, it will go up. And as it moves up, we will see that flow into the earnings of the companies. The next trigger for telecom has to be ARPU increase. In the interim, we'll see a lot of noise, but we remain positive as far as telecom space is concerned.
Sridhar, we saw some fabulous pictures from your tiger safari. Seems like confidence, not just between economy, but for people as well, is now returning. People are now willing to venture out and head out for that much needed break or holiday or whatever you may call. And now we're seeing the economy as well open up with, media, airline, multiplexes as well now opening up. Would you say that this contra theme and trade and investment is going to work now as things are beginning to pick up and beginning to return back to normalcy?
So I can say from my own experience, since I was out last weekend, the airports are really operating suboptimal right now. So are the airlines. So that's a great time to travel, I guess, because there is a lot of extra precaution as far as the airport is concerned. You have to wear a face shield and some sort of a PPE suit. So there's multiple protection as far as the airline is concerned. So this is great for the consumer. I'm not very sure how great this is for the minority shareholders and the shareholders in general, because the costs will significantly go up and you're operating suboptimal right now. Even in the resort where I was, there was 10% occupancy. So I don't know how they can, break even with such occupancy. I'm sure that some of the more popular destinations occupancies would have been much higher, but even then it would be suboptimal. So we are currently not playing this, opening trade and how, things will play out. If you ask me, we are more tilted towards, if at all we have to play this, this opening trade, we're better off with a media, play, where we are seeing ad revenues coming back, this whole threat of OTT and how that is going to destroy media companies. We are not currently seeing any evidence of that. And from a valuation standpoint, many of them are trading at, 5-year lows as far as multiples are concerned. Some of them have 5% dividend yield. So we find more opportunities in this space rather than trying to be very brave and play these opening trades. They may work for all you know, but as of now, the evidence, at least what I have seen, doesn't seem very encouraging as far as the company is concerned. Great for consumers because it hardly took 5 minutes to, do the check-in and get into a security as far as Mumbai airport was concerned.
And I can see some stunning pictures and great sightings as well of the big cats too.
Yes. There aren't too many people as far as, in the wildlife area, the interest currently is much lesser because people are not very sure whether you should travel or not. And since it's in the open, the risk of getting COVID is far lesser. I mean, I would say it's lesser than, going to the supermarket or going and buying vegetables in Mumbai. I mean, you're in the open. So I think I would recommend that if somebody wants to travel, a wildlife holiday seems to be much safer right now than any of the other travels. So I would recommend the travel, actually. The whole experience was quite good.
Indeed, the pictures are speaking for themselves. Maybe we should try that the next long weekend. But Sridhar, moving away from that, there is a big event which is haunting us, and that's the US elections. Amidst, of course, now the US president himself catching corona and now getting back home safe. How do you position yourselves ahead of this big event? And do you really take any tactical calls or let the volatility play out? Because, this time around, it's going to be a long wait from when the votes are casted and from when the results will come out.
Yeah, so actually there's a very interesting study on this that into the last month of the US elections, every time the volatility in the US markets go up multifold, almost 2 times. And the way global markets are behaving, there's only one market, which is the US markets, and the rest is mimicking what is happening in the US. So we think that getting into the US elections, we will see massive volatility even in the Indian market. So from a positioning standpoint, it is much better to play it a bit safe as you enter the last 1 month. And US elections itself, I mean, we think that's the biggest risk for the market, not because Biden wins or Trump wins. And the big issue is what happens if there is a constitutional crisis in the US, which is, if you read some of the experts, what they're suggesting is that when the results come in the first week of November, we will see that Trump is ahead because most of the Republicans would use the postal ballots to actually cast the elections. And by the time the postal ballots are counted, that could be at least 10 to 15 days from the initial results that are announced. And there's a possibility that Republicans may not accept the vote and it goes to Supreme Court. I think, to me, that is the biggest risk, if you ask me from a market standpoint, that if there is a constitutional crisis in the US and there isn't a smooth transition as far as presidential election is concerned, and then what happens? Barring that, if there is a smooth transition, I know there's a lot of worries as far as markets are concerned. But given the liquidity that we are seeing in the markets, and we don't see interest rates, especially in the US and in India, turning in the near future, we think the markets could continue to climb the wall of worries. Barring what I mentioned, the issue of the US elections, we could see the market continue to move up, despite the fact that earnings and economic growth and data may not be supportive and maybe much subpar. We would see this market moving up. At least that's the broad view.
Sridhar, I was looking at the tech P multiples, the top 4 names. TCS 25, 26 times depending on the estimate. Infosys north of 20, Tech Mahindra, Wipro, they're in the late teens now. If one looks at the assumptions for FY22, and once the base effect fades away, you could say that tech companies at best would grow in early double digit. So can P multiples of 25 times for a TCS, 20 times plus for a Infosys, mid-teens P multiple for other IT companies, can they be justified?
At this stage today, it is being justified because there is a large portion of the index that people want to be underweight. Earlier, they were all overweight, which is financials. Almost 40% of the benchmark is financials. And almost everyone was either neutral or overweight financials. As we've seen post-March, this has been one sector which has significantly underperformed. And there has been reallocation of capital from financials to the other parts of the index, and especially tech and pharma have benefited, and maybe consumer discretionary to some extent. Now, coming specifically on technology, the last time we saw such multiples for technology was back sometime in 2010-11 and maybe going into 12. When actually the tech companies coming out of the Lehman crisis started, their growth rates were north of 20%. I remember TCS in 2011, I think, grew at almost 25% in terms of revenue growth. And my recent interaction with all the tech companies, one of the questions I asked is, are you seeing any similarity of this with what happened in 2010 to 14 period when Indian tech company last time saw north of 15% average growth rate? The data is not suggesting that they are seeing such growth. Maybe the growth rate improved by 200 basis points or 300 basis points, but it's not suggesting that we are anywhere close to where we were in that period. So my view is that they are slightly on the overvalued territory, and I'll be very careful in chasing these stocks from here on.
Sridhar, for those who've bought into the whole proposition of Sasta Sundar Tikau, which is buy stocks which are cheap, buy businesses which are here to stay, one day somebody will recognize them. That includes NTPC, cement companies, steel companies, value names like PSUs. All of them are just feeling left out and their portfolios are bleeding. So where is value investing? I mean, we've been talking about value investing will come back, will come back, will come back. If I may say the word again, will come back. It's been 10 years.
Well, I'm not a big fan of value investing, and especially when it comes to PSUs. I mean, that's a value trap, and we've seen this time and again. So I don't see any merit in going into this. The only thing that could change this PSU valuation value trap is if the government successfully privatizes, either BPCL or Container Corporation or Air India, and then we could see a re-rating. I know there is a lot of talk right now. There are processes which is going on, but I guess the market currently is still in the denial mode that this is not going to happen, or it may get delayed. And we would also want to see at what price some of these divestments happen. But otherwise, broadly speaking, these companies have actually destroyed wealth. I mean, even though they generate a lot of cash in many of the businesses, I don't think the cash really is utilized in the most optimal manner, which is beneficial to shareholders. So I guess the stock prices today reflect the disappointment of how these companies have behaved over the last 10 years. And that's how I think the entire PSU basket, excluding the banks, has only market cap of 8 lakh crores. I mean, it's quite shocking, which includes the ONGCs and the IOCs of the world. So I think that number is quite shocking that the entire PSU basket has come down to such a level. I think it's a value trap. I would stay away. The only trigger for this is privatization, as and when it happens. Even then, only the ones which the government will privatize will have some play. The others will continue to languish, barring once in a while they will move up. So I would say this whole value play is a very tough game to play, and I would generally avoid it.
So there are lots of buzz with these new listings. There's been a lot of interest generated from investors, some pretty fabulous subscription numbers and interesting IPO listings as well. Anything within that space that's caught your eye or that you believe merits a closer look?
No, actually, many of these companies which have got listed, there are reasonable peers available in the listed space which are trading at much better valuations. I don't see any reason to chase any of these newer listings the way they have. I mean, there seems to be some sort of a scarcity premium right now where some of these companies are getting, and we really don't have enough data to suggest or to prove their credibility. Whereas in many of the listed companies, we do have more data. So I wouldn't be chasing this new listing. We've seen in the past this happens, and then as the data is not supportive, we see disappointments come in. So I would rather go with the tried and tested ones where we have more data, we have institutional memory of how the managements have behaved over good times and bad times. I would not jump in if the valuations is not supportive.
Yourself for when it comes to the earnings season? Any particular sectors that you think will see outperformance? Any weakness? Where do you think we'll see the positives and the negatives?
So as we mentioned, agri is one of the space where we will see some positive. Consumer discretionary, which is autos, will see good numbers because we are seeing some of those numbers already come through as we get the monthly data. But a lot of it could also be because of the festive season, the inventory pipeline is getting filled. But broadly speaking, I think the markets sort of moved beyond earnings because everybody is looking at earnings for 21, 22. And I don't think anybody is so focused on what happens to current year earnings. So I think the market has a free run. We may want to focus on earnings here and there, but I don't think it will make too much of a difference unless the commentary for the next year isn't that optimistic. I think broadly the markets will ignore good and bad. Maybe the good results, they will get some more appreciation. But I think that's my broad view that market has a free run for three more quarters, and it's only the earnings of 21, 22 which is relevant as far as some serious movements either way is concerned.
Okay, Sridhar, good chatting with you as always, and we look forward to your next holiday and the pictures from there.
Sure. Thanks a lot.